Hi friends, good day. Today, let us try to understand about what is debit, what is credit, what are the elements of financial statement, what are the types of accounts, and what are the golden rules of accounting through this video. According to Kunal Shah, only inflexibility you need and can afford to have running a business is your values. Before we go in,
please subscribe for more videos. Click the bell icon for updates.
Debits and credits are used to record transactions in a company's chart of accounts. A chart of accounts classifies income and expenses. A debit is an accounting entry that increases the asset or expense accounts and decreases liability on a company's balance sheet. A ledger account consists of two sides, a left-hand side and a right-hand side. A debit is on the left and credit is on the right side of an entry. In practice, debit is denoted by DR and credit is denoted by CR. Credit increases the liability, revenue or equity accounts and decrease asset or expense effect, which is the opposite of the debit entry. So the debits are balanced by the credits as they both work in opposite directions. For example, purchase an asset or an equipment for the company, it would debit fixed assets and at the same time credit a liability account, which means that it increases machinery and decrease cash as the equipment or the asset comes in and cash goes out of the business. The increase in machinery and decrease in cash must be recorded in the machinery account and the cash account respectively. As mentioned earlier, every ledger account has a debit and a credit side. Now, depending on the nature of the account, the increase or decrease of the account is to be recorded. This is decided with the help of normal balance of accounts and the rules of credit and debit. The understanding of normal balance of accounts helps in understanding the rules of debit and credit easily. The normal balance of all assets and expense accounts is debit, whereas the normal balance of all liabilities and equity or capital account is credit. If the normal balance of account is debit, then any increase in that account is recorded on the debit side and any decrease on the credit side. Contrarily, if the normal balance of an account is credit, any increase in that account is recorded on the credit side and any decrease on the debit side. There are 5 major elements of financial statement. Number 1. Asset account. Assets are normally debits. These are the items that provide future economic benefit to a company. They include the company's movable and immovable property and goods like cash, bank balance, goodwill, furniture, etc. Examples of the asset account are cash, accounts receivable, inventory, prepaid expenses, property and equipment, vehicles. Normal balance debit. Rule: any increase is recorded on the debit side and a decrease is recorded on the credit side of all asset accounts. Number 2. Expense account. These are the charges related to the day-to-day operation of the business. Examples of the expense account are rent, electricity, travel, salaries, postage, stationery, utilities. Normal balance debit. Rule: any increase is recorded on the debit side and the decrease is recorded on the credit side of all expense accounts. Number 3. Revenue or income account. This shows the income earned by the company from the sale of products and services or interest from investments. Examples of the revenue accounts are sales revenue, service revenue, interest income, investment income. Normal balance credit. Rule: an increase is recorded on the credit side and a decrease is recorded on the debit side of all revenue accounts. Number 4. Liability account. These are the obligations that the company is required to pay. They indicate the amount payable by the company to the creditors. For example, accounts payable, income tax payable, loans payable, bank fees. Normal balance, credit. Rule: an increase is recorded on the credit side and the decrease is recorded on the debit side of all liability accounts. Number 5. Capital or equity account. These accounts are the net asset entries for the value of a company's non-operational assets after the liabilities have been paid. For example, stocks, bonds, available for sale securities, mutual funds, real estate, debit security, derivative instruments, pension and retirement plans. Normal balance, credit. Rule: an increase is recorded on the credit side and a decrease is recorded on the debit side of all equity accounts. Golden rules of accounting. Every account will fall in one of the broad classifications. There are 3 types of accounts. 1. Real accounts. 2. Personal accounts. 3. Nominal accounts. Let's look into them one by one. Number 1. Real accounts. A real account is a general ledger account relating to assets and liabilities other than people accounts. Rule: debit what comes in and credit what goes out. Real accounts constitute of all assets like building, land, road, machinery, plants, etc. Number 2. Personal account. It is a general ledger account connected to all persons like individuals, firms, and associations. Rule: debit the receiver and credit the giver. Personal accounts constitute accounts of partners, shareholders, that is capital and drawings account, customers, etc. Number 3. Nominal account. It is a general ledger account pertaining to all income, expenses, losses and gains. Rule: debit all the expenses and losses, credit income and gains. Nominal account constitute of expenses and income accounts and also profit and loss. Well, thank you so much for watching. Please like this video and do share.